Welcome back to another edition of The Deep Dive, and specifically, you are tuning into Talk Tickers.
That's right.
This is the show for the professional investor, or, the aspiring professional, who wants the alpha without all the agony.
We get it. Your day is packed. You don't have hours to sift through earnings call replays at 1.5 speed, let alone 1x.
Exactly. Or try to read 100 pages of transcripts and dense footnotes while you're trying to eat your lunch. We do that heavy lifting for you.
We read the footnotes, we try to parse the CFO's tone of voice, and we strip out all that PR fluff to find the signal.
And today, we're locking in on a company that I think really acts as the nervous system of the digital economy.
It's good to be back, and you're right, this is a really significant one. Today we are breaking down the Q4 2025 earnings call for Twilio, ticker symbol TWLO.
TWLO.
And this call, it took place post-market on Thursday, February 12th, 2026.
That's right. We were recording this on Valentine's Day, February 14th. So, you can consider this our love letter to financial due diligence.
Or maybe a love letter to the misunderstood infrastructure of the entire internet.
Huh. I like that. Or, maybe a love letter to volatility, depending on how you're looking at the tech sector right now.
Well, there's certainly enough of that to go around, no question.
Exactly. So before we get into the weeds, and we are going to get deep, deep into the weeds today, let's do a quick vibe check on the price action.
Always the first place to start.
Because let's be honest, this is the very first thing everyone looks at when that notification hits their phone. The market closed around $110.41 before the print came out.
Right. And then in the after-hour session, immediately following that release, the stock moved to roughly $111.25.
So we're talking about a move of what, plus 84 cents?
Yeah, which is about 0.76%, so less than 1%.
And in the world of high beta tech, where we regularly see 10, 15, sometimes 20% swings on an earnings print, a 0.76% move is, it's effectively flat.
It's a non-event. It's a rounding error in this sector.
And that, right there, that sets up the central tension for this entire deep dive. Because as we're about to unpack, this company just beat on the top line, they beat on the bottom line, and they raised their guidance.
It's the classic good news is no news scenario, or at least that's what it looks like from the surface. But when you really dig into the transcript, which, I've spent the better part of the last 24 hours doing, there is this war going on between two different narratives.
Okay.
On one side, you have this show me story. These are the investors who've been burned before, right? They're waiting for that explosive growth to come back. And they're really skeptical of the kind of commodity nature of the business.
And the other side?
On the other side, you have management who are basically screaming, politely, of course, on the call, that the AI pivot is actually happening right now. It's in the numbers, not just some slide deck fantasy.
And the market is just sitting there with its arms crossed saying, prove it.
Show me the money.
Yeah.
Exactly.
So here's our roadmap for today. We've got a lot to cover. First, we're going to hit the snapshot, the headline numbers you need to know so you don't sound out of the loop at your Monday morning meeting.
The essentials.
Second, we are going into the deep dive. We've identified 4 key themes that really jumped out from this call. The voice AI renaissance, which is fascinating. Then the confusion around legends, which is a huge topic we need to unpack.
That's a really important one, yeah.
Then the whale deals they're signing in the enterprise. And finally, this newfound financial discipline. After that, we'll zoom out for some investor context, and we'll wrap up with our not financial advice segment, where we pitch a trade that is, frankly, a little unhinged.
Unhinged is the strong word, but, I'll allow it. Let's get into the numbers.
Okay, let's do it. Let's look at the scoreboard. The snapshot. Headline financials first. Revenue came in at $1.366 billion.
Right. And the consensus on the street was sitting somewhere around $1.317 billion.
So that's a solid beat. We're talking about roughly $49 million beat on the top line?
It is. And in this kind of environment where, software spend is under a microscope and every CFO is scrutinizing their IT budgets, finding an extra, almost $50 million in a quarter, that's not nothing.
No, it's really not.
It's a meaningful divergence from what people were expecting. It suggests that, usage was just hotter than anticipated across the entire platform.
It is significant. And if you look at the growth rates, reported revenue is up 14% year over year.
And organic growth, which, that strips out some of the noise from M&A and things like that, that's up 12%.
Okay, so that's the top line. Let's talk earnings. Non-GAAP EPS. That came in at $1.33.
And the street was looking for $1.23 fit.
Another dime beat.
A 10-cent beat on the bottom line. So you have a top line beat and a bottom line beat. I mean, this is exactly what you want to see as an investor. It shows real operating leverage.
What do you mean by that specifically?
It just means that the extra revenue they brought in didn't get immediately eaten up by new expenses. It actually flowed down to the bottom line to profitability.
But, and there's always a but, with software accounting, we have to mention the GAAP reality.
Of course.
GAAP EPS was a loss of 30 cents.
Right. But we need to add some nuance to that. While they did have a GAAP loss per share, and that's largely due to some one-off items and stock-based comp, which we'll definitely get into later, they did post positive GAAP operating income.
Okay, and that number was?
$56.8 million. And this is actually a really important milestone for the company. They are now GAAP profitable on an operating basis for the full year.
So this isn't the Twilio of, say, 2021 that was just burning cash like crazy to fuel growth.
Not at all. They've crossed the Rubicon. They've moved into actual, real operating profitability.
Speaking of cash, let's look at the quality metrics. Free cash flow. This is the number that, keeps the lights on and lets them buy back stock.
It was a monster quarter for cash, an absolute monster. $256 million in free cash flow just for the quarter.
Wow.
That is a 19% margin. I mean, if you were to annualize that, you're looking at a company that's generating $1 billion in pure cash.
So it's a cash-generating machine now.
It is, and that completely changes the investment thesis. It shifts from, I hope they grow, to look at the cash they print. A 19% FCF margin for a company still growing at double digits is very, very healthy.
Okay, what about retention? The DBNER, dollar-based net expansion rate. This metric has been the bane of their existence for 2 years as it just compressed from those insane pandemic highs.
It's been a tough ride down for that number, for sure.
Where are we now?
We are at 109%. It is stabilizing.
So not the 140% of the glory days.
No, and frankly, we're probably never going to see those kinds of numbers again for a company this mature in this space. But 109% is key. It means that for every dollar a customer spent last year, they're spending $1.09 this year.
It shows the bleed has stopped.
Exactly. The bleed has stopped. Customers are expanding their usage again. They're adopting new products. And most importantly, they're sticking around. So stabilization here is absolutely crucial to the bull case.
And finally, the outlook. Because, as we know, markets trade on the future, not the past. What are they telling us about 2026?
So for Q1, they're guiding revenue to $1.335 to $1.345 billion.
Which is?
That's 14 to 15% growth year over year. But the real signal, the number that all the analysts are plugging into their models right now, is the full year 2026 organic growth guide. And that is 8 to 9%.
8 to 9%. Now, to the uninitiated, that sounds, well, modest.
It sounds like a utility company, right?
Yeah, exactly.
It is modest, but here's the key context. They are guiding above the framework they laid out at their last investor day.
Okay, that's important.
It's very important. Usually companies use these Q4 earnings calls to subtly walk back expectations or, lower the bar so they can easily step over it later in the year. Twilio's doing the opposite. They're raising the floor.
So they're saying, actually, things are going a little bit better than we thought.
Precisely. Management specifically said they are guiding above their investor day framework. That shows a ton of confidence.
Okay, so let me get this straight. We have a beat, we have a raise, and we have cash flow machine. Yet the stock is totally flat.
Yeah.
To understand why and to really understand the opportunity here, we have to go deeper. We need to look at the engine under the hood. Let's start the deep dive.
Let's do it.
Theme number 1, and this is the one that really got me excited reading through the transcript. It's the AI wedge and what they're calling the voice renaissance.
This is the pivotal narrative shift for the company. I mean, for years, Twilio was just the SMS company.
Right. You get an Uber, you get a text, you order a pizza, you get a text. That was the whole pitch.
Exactly. And management is now very, very clearly pivoting that pitch. They are no longer just selling communications APIs. They are pitching themselves as the foundational infrastructure layer in the age of AI.
It sounds a bit like buzzword bingo, I know.
Sure.
Every company is an AI company now. But they actually brought the receipts this time. The data point that just jumped off the page at me was their voice AI revenue growth.
It accelerated to above 60% year over year.
60%. I mean,
Yeah.
that is hyper growth territory. That's the kind of number you expect to see from like a seed stage startup, not a multi-billion-dollar public company.
It really is. And we need to explain why this is happening because it's a fundamental shift. Historically, Twilio's voice business was, humans calling other humans, or maybe a very basic IVR.
The annoying press 1 for sales, press 2 for support menu that we all hate.
Exactly. What is happening now is a complete change in who or what is making the call. It's no longer a human agent in a call center in, the Philippines or Arizona. It is an AI agent built by startups like Sierra or Poly AI calling a human.
And Twilio is the vocal cords.
That's the perfect analogy. Twilio is the vocal cords for the bots. I mean, think about the tech stack here. If you are building an AI agent to handle customer service for an airline, you need the brain, right? That's the LLM, the OpenAI or Anthropic model that's processing the logic.
But you need a way for that brain to talk to the world.
Exactly. You need the mouth and the ears to actually connect to the old school telephone network, to hear the user's voice, transcribe it, and speak back in a natural way. That is Twilio. They are the bridge between the digital brain and the analog telephone network.
And it's not just these hot new startups that are driving this, right? They mentioned it was pretty broad-based adoption.
Correct. They did mention Sierra specifically, which is a big deal. Sierra is one of the hottest companies in the customer experience AI space right now. It was founded by Brett Taylor, the former co-CEO of Salesforce.
So a major player.
A very major player. And they signed a new deal to continue leveraging Twilio's voice functionality. But it's also the big enterprises who are now building their own internal bots. The sheer volume of minutes being driven by machines talking to people is just exploding.
So it's not just about providing the phone line for the minute, it's about the software around it.
Yes, and that's a key point they made. Sierra is also using their software products like conferencing to support more complex things like multi-party calling or even taking a payment securely over the phone.
So the complexity is where the margin really lives.
Exactly. The commodity is the minute, the value is in the software layer on top of it.
There was another stat in there that absolutely blew my mind. It was about branded calling. Revenue up 6x year over year, 600%.
Yeah, and this connects directly to what they call the spam problem. I mean, think about your own behavior. If you get a call from an unknown number, do you ever answer it?
Never. Absolutely never. If it's important, they'll leave a voicemail or, send a text.
Right. Nobody does. And that completely breaks the business model for legitimate companies that are trying to reach you, whether it's your dentist confirming an appointment, your delivery driver saying they're outside,
or your bank trying to verify a suspicious transaction.
Exactly. So Twilio's branded calling solution puts a logo and a name on the caller ID on your smartphone.
So instead of seeing unknown number or that dreaded scam likely, it'll actually say Delta Airlines with the Delta logo next to it.
That's exactly what it does. And the data they have shows that this drastically increases pickup rates. And if pickup rates go up, the ROI for that customer goes way up.
Because if the customer answers the first time, the problem gets solved, and the company doesn't have to pay an agent to call back 5 more times.
That's it. That's why revenue for the specific product is up 600%. It is a direct solution to a broken ecosystem.
It's really interesting because that's a true value add. That's not a commodity pipe. That is something you pay a premium for because it solves a painful business problem.
Precisely. And that's where they are desperately trying to move the entire business away from commodity SMS, where price is the only factor, and toward these intelligent, authenticated interactions where trust is actually the product they're selling.
Speaking of authenticated interactions, we have to talk about RCS, Rich Communication Services. This has been the next big thing in telecom for, like a decade? And it never happened.
It was total vaporware for the longest time.
But now, they said volume was up 5x. Not year over year, but quarter over quarter.
The dam has finally broken on RCS. And the reason is largely ecosystem support. Apple finally agreed to play ball and support RCS on the iPhone, and Android has been pushing it hard. It essentially turns the old SMS inbox into an app-like experience.
They gave a really great example of this with Ramp, the financial operations company.
Yes, that was a perfect use case. Ramp is using RCS for things like receipts and two-way transaction verification. So imagine you swipe your corporate card instead of getting a really dry text that just says, "Did you spend $50 at Starbucks?"
You get a branded message, maybe with the Starbucks logo, and a button that you can tap to verify it, or a way to upload a photo of the receipt directly in the message thread.
And it keeps the user in their native messaging app, which is where everyone lives all day. It removes so much friction from the process.
It feels like the text message is finally growing up. It's kind of becoming an elite version of WeChat for the West.
It is. And for Twilio, RCS is a much richer and potentially much higher margin channel, especially if they can layer on all those value-added services. It defends against the bear case that messaging is dead.
And just to wrap a bow on the sheer scale of this operation, because I think sometimes we forget just how big Twilio is. Cyber Week.
The numbers are staggering.
Just in that 1 week, they processed 6.99 billion messages.
And 1.07 billion calls.
I mean, the scale is just undeniable. When you are processing almost 7 billion messages in a single week, you have a data advantage that is almost impossible for a startup to replicate.
That's the hidden asset here. You see the traffic patterns, you see the delivery rates across every single carrier in the world. You know which routes are failing before anyone else does. That data is the real moat.
Okay, so that's the exciting stuff, the AI, the growth, the scale. Now we have to, eat our vegetables. You have to talk about theme 2, the margin noise. Because if you just looked at the summary table in the press release, you saw gross margins drop to 49.9%, down 200 basis points year over year.
And in the software world, dropping below a 50% gross margin is usually a massive red flag. It scares people off. It implies, intense pricing pressure, or that your competitors are just eating your lunch.
Right. It screams race to the bottom. But management spent a lot of time on the call. I mean, probably too much time, frankly, explaining why this is a technicality. Break this down for us. What is happening with the carriers?
So here's the mechanism. Twilio sits in the middle, right, between the software developer on one side and the big telecom carriers, Verizon, AT&T, T-Mobile on the other.
The middleman.
The middleman. To send a text message from an application to a person, Twilio has to pay a little toll to these carriers. These are called A2P application of person fees.
They're the toll booth on the information superhighway.
Exactly. And recently, the carriers all decided to hike these fees. I mean, hike them significantly. Now, Twilio's model is a direct pass-through.
What does that mean?
It means if Verizon decides to charge an extra penny for a text, Twilio just charges their customer an extra penny. They don't mark up the fee, they don't eat the cost, they just pass it straight along.
Okay, so mathematically, what does that do to the financials?
Let's do some simple math. Let's say, in the old world, Twilio charged a customer $1 for a service, and the cost they paid to the carrier was 50 cents.
Okay, so that's a 50-cent profit or a 50% gross margin. Simple enough.
Right. Now, let's say the carrier raises their fee by 50 cents. So Twilio's cost is now a full $1. To maintain their profit, Twilio has to raise the price to the customer to $1.50 to pass that fee through.
So they're still making the same 50 cents of profit. The actual cash in the bank is the same.
Exactly the same. But now their margin is 50 cents of profit divided by a new higher revenue of $1.50. And that comes out to roughly a 33% margin.
Wow. So the profit dollars, the actual cash, stayed exactly the same.
Yeah.
But the percentage, the thing everyone looks at, looks like it completely crashed.
Precisely. The revenue denominator gets bigger because of the pass-through fee. The cost of goods sold gets bigger by the exact same amount, so the gross profit dollars are flat, but the percentage margin drops. Management is basically screaming from the rooftops, look at the dollars, not the percentage.
And they gave guidance on this. They said to expect around 170 basis point headwind to gross margin in fiscal year 26, purely from this optics issue.
Correct. And for a sophisticated investor, for our listeners, you have to strip this out. You have to look at gross profit dollar growth. And on that front, they expect gross profit dollars to track right along with organic revenue growth.
And that's the healthy signal.
That's the healthy signal. If gross profit dollars were shrinking, we'd have a massive problem on our hands. But they aren't. This is purely a function of the carriers having pricing power and it impacting the optical margin percentage.
It's a really crucial distinction. If you're just an algo screening for stocks with gross margin greater than 70%, you're going to miss Twilio completely.
Yeah.
But if you understand the pass-through dynamic, the picture changes.
It absolutely does. But, it also highlights a risk here. The carriers have a lot of power. They can squeeze the pipe whenever they want. Twilio's defense is that they're the only ones with the scale to properly negotiate and optimize these routes globally. But it is a constant reminder that they play in a sandbox that's owned by the telcos.
The super network is their moat, but the ground underneath it is owned by AT&T and Verizon.
Well said. That's a great way to put it.
Fair point.
Yeah.
Okay, let's move on to theme 3, go-to-market and the enterprise pivot. Because for a long time, the bear case was that Twilio was just for startups. Uber used them when they were small, but once you get big, you build it yourself or you negotiate directly with the carriers.
That narrative is taking a real beating with this quarter's results. They made a point to highlight their whale wins.
And those are defined as
Large deals. So, customers who are paying more than $500,000 in annual recurring revenue. That cohort grew 36% year over year.
that is robust. That's not startup growth. That's serious enterprise adoption. And they dropped a very specific anecdote about a 9-figure renewal.
A 9-figure renewal. That means a contract worth at least $100 million. They didn't name the client, of course, but they described them as a leading marketing automation platform.
So think something like a Salesforce Marketing Cloud or a HubSpot or a Klaviyo.
Exactly. And they said it's the largest single deal in the company's entire history.
$100 million on SMS and voice. That is just wild to me.
It really shows how critical this infrastructure has become. If you are one of those marketing automation platforms, you absolutely cannot afford for your messages to fail. You need deliverability. You need global scale. You are writing a $100 million check because Twilio is mission critical. If Twilio goes down, your entire product breaks.
They also talk a lot about shifting from selling products to selling solutions. We hear this a lot in enterprise software. What does that actually mean in practice for a company like Twilio?
It means they're moving away from the old model of, here is an API, good luck writing the code, and moving toward a model of, here is a prepackaged agent productivity bundle. They gave the example of a company called Dental Pro via an integrator called Exilab.
Right, the dental office example.
Instead of just selling them a bunch of phone lines, they sold them a full solution using Flex, which is their contact center software, along with voice and messaging, to build a virtual agent for booking dental appointments.
So the AI answers the phone and books the appointment.
Right. And the result was a significant uplift in service levels, meaning more calls were answered, more appointments were booked, and the human receptionists were freed up to do other things. And this is sticky. Once you build your core business workflow on top of a Twilio solution like that, you are not switching to some cheaper commodity provider just to save a fraction of a penny per message.
You're locked in by the value, not just the price.
Exactly. You're locked in by the workflow integration.
And it seems like that bleeding from the post-COVID come down has finally stopped. A lot of companies were optimizing their spend for a while there.
It appears so. They said enterprise procurement is stabilizing. That optimization phase where every company was looking to cut their Twilio bill seems to be over. Plus, you have to remember, their self-serve engine, the product-led growth motion, is still humming along. Self-serve revenue was up 28% year over year.
So they have both motions working. They have the land motion with the self-serve developers signing up with a credit card.
And then they have the expand motion with these massive 9-figure enterprise deals being signed by the sales team. It's a healthy, dual-pronged approach.
Let's hit the last theme here. Theme 4, discipline and profitability. This is what I call the grown-up software company theme.
This is the Cosima Ship Chandler era. I mean, since he took over as CEO, the mantra has been discipline, discipline, discipline. Just look at stock-based compensation, or SBC.
That was a huge issue for them, right? The activist investors were all over it.
It was a massive number back in 2021. It was diluting shareholders significantly. It is now down to 11.3% of revenue. They are finally getting serious about managing dilution.
And they're backing that up with actual cash with the buybacks.
Very aggressive buybacks. They repurchased $198 million worth of stock in Q4 alone. For the full year 2025, they bought back $855 million.
$1 billion in buybacks.
Almost. And they have a war chest left over. They have about $1.1 billion remaining in the authorization that runs through 2027.
When a tech company that is still growing buys back that much stock, it sends a pretty clear signal. It says, we think our stock is cheap.
It says that, or it says, we don't have anything better to do with the cash. But in this case, given the valuation compression we've seen in their stock over the last few years, it looks like a very prudent use of capital. They're shrinking the float.
And if you combine those buybacks with the reduced SBC,
they are actually returning real value to shareholders, which is still kind of rare for a software company that's growing at a double-digit clip.
net burn rate was just 1.5% for 2025. Their target was less than 3%, so they beat that too. They're just running a much tighter ship now.
A very tight ship. This is a profitable, cash-generating business. The days of growth at all costs are dead and buried at Twilio. They have graduated to the Rule of 40 class, where they're balancing growth and profitability effectively.
Okay, so we've unpacked the quarter. Let's zoom out a bit. Let's talk investor context. We have this flat stock price, but a business that seems to be firing on most cylinders.
Yeah.
What is the bear case versus the bull case right now? If I'm sitting on the fence, what are the two arguments?
The bear case is simple, and it's compelling in its own way. It's just dead money.
Explain that.
The stock is down about 10% over the last year, while the S&P 500 is up 16%. The bears say, look, this is a commodity pipe. The carriers are squeezing their margins. The growth is slowing to the high single digits, that 8-9% number. Why would I buy this when I can buy a high-flying AI chip stock or another software company that's still growing at 30%?
And they see the carrier fees as a structural negative.
Exactly. They see those fees making the model look structurally worse, and they worry that eventually SMS volumes are just going to peak and decline as everyone moves to WhatsApp or other over-the-top channels.
That is a fair concern. I mean, it's hard to get excited about single-digit growth in the tech space. What's the bull case?
The bull case is that this is a classic value play disguised as a tech stock. You are getting a company with 19% free cash flow margins. That's buying back massive amounts of its own stock, and it's trading at a reasonable multiple.
And the kicker is the AI story.
The kicker is the AI option value. They are the picks and shovels for the entire AI agent revolution. If you believe fundamentally that AI agents will replace a significant portion of call centers, you almost have to be long Twilio because those agents need a way to talk. The bill says the market is completely ignoring the 60% voice AI explosion because they're too focused on the boring SMS margin compression story.
It's the classic picks and shovels argument. You don't know which AI agent startup is going to win, but they all need to buy their shovels from Twilio.
That's it, exactly. And let's look at the sector impact. We mentioned CPA's earlier communications platform as a service.
Right. How are the competitors doing in this environment?
Competitors are struggling. I mean, really struggling. Many of the smaller CPAR players, the pure play messaging aggregators, are seeing their growth completely evaporate. Twilio is taking share.
And why are they winning?
They're winning because of the platform approach. It's not just about sending a text anymore. It's the combination of the data with their segment product, the identity with their Verify product, and the communications layer all working together.
Verify grew at over 25%. We kind of glossed over that earlier, but that seems pretty important.
Verify is the sleeper hit in their portfolio. In a world of AI deepfakes and rampant spam, identity is the new moat. If you control the verification layer, the two-factor authentication codes, the prove you're human step, you control the entire transaction.
Twilio is becoming the identity layer for the internet's communications.
It's a sticky, high-margin business. If you are verified by Twilio, you are trusted. And in this environment, that trust is incredibly valuable.
Let's talk macro for a second. Management is guiding 8-9% organic growth for the full year, but Q1 is starting out at 10-11%. Why the drop-off? Do you think they're sandbagging the numbers?
It certainly feels like it. I mean, management called their usage-based models volatile, which is true.
Right. If the economy tanks, there are fewer Ubers, fewer DoorDash orders, fewer marketing texts being sent.
Exactly. So they are being prudent and forecasting cautiously for the back half of the year. But if the economy just holds up, and if this AI-driven volume continues to layer on top of the base, that 8-9% guidance looks very, very beatable.
It's a raise-the-floor situation, like we said earlier.
Yeah.
They're setting themselves up to beat and raise throughout 2026.
I think so. It's classic under-promise, over-deliver.
And we have a catalyst on the horizon.
May 2026. Signal Conference. This is their big annual user and developer conference. And management explicitly teased new AI launches coming at Signal.
So in the narrative arc of a stock, that is the next story checkpoint.
It is. Investors will be looking for a breakout product announcement that monetizes this AI trend even more directly. Maybe something related to agent orchestration or long-term memory for bots.
Okay, we've done the homework, we've analyzed the numbers, we've looked at the strategy. Now, it is time for the segment that our legal team absolutely hates, but the listeners seem to love.
The disclaimer is always implied, but let's just say it anyway. This is not financial advice. We are two voices on a deep dive. We are not your financial advisors. Please do your own diligence. Don't sue us.
Exactly. This is the not financial advice segment where we pitch a trade idea that is wild, speculative, but, just might work. I'm calling this one The AI vocal cords arbitrage.
I like the title. It sounds very sophisticated. Walk me through the structure.
Okay, the concept is this. Everyone is obsessed with the brain of AI, right? They're buying NVIDIA for the chips, they're buying Microsoft for the models, but an AI agent is completely useless if it can't interact with the real world. It needs a voice.
I agree. Intelligence without an interface is just a brain in a jar. It can't do anything.
So the trade is a pair trade. You go long, Twilio, ticker TWLO, and you go short. A basket of legacy BPO stocks.
BPO?
Business process outsourcing companies. The massive legacy call center operators like Teleperformance or Concentrix.
Ooh, that is spicy. You are betting directly on the replacement cycle.
Exactly. Twilio just told us that their voice AI revenue is up 60%. That volume has to be coming from somewhere. It is directly replacing human agents in Tier 1 support roles. Every minute an AI talks on a Twilio line is a minute a human isn't billing hourly at a BPO.
And the economics are just brutal for the BPOs. They have wage inflation. Humans want raises. They need to take breaks. They churn. Twilio, on the other hand, has software deflation. The cost of intelligence is dropping exponentially.
Plus, Twilio is buying back its own float, putting a floor under the stock. The BPOs are facing a genuine existential crisis. So you go long the technology that is replacing the labor, and you go short the labor arbitrage model that is rapidly becoming obsolete.
That is a very compelling hedge fund pitch. You're hedging out the macro risk, right? If the economy slows, both might get hit, but the pair trade is designed to capture the alpha, the technological displacement itself.
I like it. Do you have a YOLO alternative for the options traders who want a bit more leverage?
I do. Of course I do. I call it the RCS breakout call spread.
Okay.
We talked about RCS volume being up 5x quarter over quarter. If Apple and Android really do turn the SMS inbox into a mini app store where you can book flights, pay bills, and verify your ID all inside the message thread, then the multiple on Twilio shouldn't be a telecom utility multiple of, say, 15x earnings.
Should be a software platform multiple, something closer to 25x.
Right. If the market starts to perceive them as the WeChat for the West, the valuation completely re-rates.
So what's the trade?
You buy the January 2027 LEPS. Those are the long-term call options out of the money. You are basically making a leveraged bet that between now and then, as the Signal conference hits and the 2026 numbers roll in, the market wakes up and re-rates the stock from a pipe to a platform. Very high risk, very high reward. Pure speculation.
Absolutely. Do not bet the farm on this. This is casino money. This is for fun.
But it does track with the data that we saw in this quarter. The seeds for that narrative are definitely there.
All right, let's wrap this up. Recap for the people driving home from the office.
Twilio Q4, they beat, they raised, and they are buying back a ton of stock. The boring surface of the flat stock price and the margin noise is hiding a massive 60% growth shift into voice AI.
The stock price might be sleeping, but the cash flow is wide awake.
Management called this a balanced year ahead. But I think in 2026, balance is code for we are profitable, we are safe. Now please leave us alone while we go and build the AI future.
If you want to catch the next deep dive, make sure you are subscribed to Talk Tickers. We will be breaking down the next big tech print as soon as it hits the wire.
Keep your eyes on the tape.
See you next time.